Turning to the device clause, Section 355A1B provides that a transaction will not qualify under Section 355 if it was used principally as a device for the distribution of E&P of the distributing or controlled corporations or both. Section 355A1B further provides that a sale of stock after the stock distribution will not be construed to mean that the transaction was principally intended as a device unless prearranged. But this statement should be read with caution in light of the regulations which view stock sales harshly. These are the statutory dictates for the device clause, a very central theme in Section 355. The main concern is best summed up in Reg 1.355-2D1, which recognizes that a tax-free distribution of stock of a controlled subsidiary presents an extraordinary potential for tax avoidance. What is meant by a device to distribute earnings? The focus is on the ability to get cash or other property out to the shareholders while continuing to maintain ownership interests in the core corporate assets and corporate solution. The notion here is that the result of the transaction might be very similar to a dividend of the cash or other property. Regulation 1.355-2D discusses many of the considerations in determining whether a device exists. The body of the rules come in three parts. First, factors suggesting a device exists. Second, factors suggesting a device does not exist. And third, transactions which would not ordinarily be considered a device, even if the factors would otherwise suggest a device. The approach then is this: determine the factors suggesting a device exists, determine factors suggesting a device does not exist, and then weigh them together. The side with the greater weight tentatively determines the outcome. But if the transaction is one which ordinarily would not be a device, which is the third part of the rules, then notwithstanding that the factors weigh more heavily toward device, the transaction is not ordinarily considered a device. Let's first consider factors suggesting a device. Starting with stock sales. I would note post-distribution sales of stock seem to receive the harshest attack as being devices. Reg 1.355-2D2, III, or 3 little I if you will, has the following points regarding sales of stock. First, a subsequent sale of stock in either the distributing or controlled corporation is evidence of a device. Second, the more stock sold, the stronger the evidence. Third, the shorter the period of time that it has elapsed from distribution to sale, the stronger the evidence. Fourth, if the sale is pursuant to a previously negotiated or agreed upon plan, then there is substantial evidence of a device. Fifth, a sale is always considered prearranged or pre-negotiated if pursuant to enforceable rights to buy or sell. Even a discussion to sell would ordinarily be considered a prearrangement or pre-negotiation if both parties reasonably anticipated a sale. And six, any sale, even if not prearranged or pre-negotiated, will be considered as some evidence of a device. The attacks against sales is based on the theory that a sale is not significantly different from the corporation selling a business and distributing the proceeds. Another way of looking at it is that a sale it goes contrary to the notion of the division of long-standing businesses. Why are you dividing long-standing businesses just to sell them? That again is sort of the contrary to the notion of what 355 is about. One final point on sales of stock. The above provisions regarding sales of stock do not apply to subsequent tax-free reorganizations. Note the fact that Section 356A might require partial recognition is ignored for this purpose as long as the gain recognized is insubstantial. So this point bears repeating. you can prepare a target corporation for a reorganization by an initial Section 355 transaction, spinning off the unwinded assets in a controlled corporation, then exchanging stock of the distributing company with the acquirer. Note, though, other issues discussed later can come up in this context. Other factors suggesting that a device exists involves the nature and use of assets in each of the corporations after the transaction. Included among the concerns here is the acquisition of a new trade or business, in other words, within the last 5 years, which is considered evidence of a device. Also, committing disproportionately more liquid assets to either corporation, either distributing or controlled distributed corporation, than is needed for business needs is evidence of a device. Furthermore, a continued relationship between the corporations is evidence of a device, especially if the relationship is an exclusive vendor-vendee relationship. But a continued relationship is only a factor if the separated business can be sold off without adversely affecting the business from which separated. The theory here is that if there isn't significant need for the new business to seek or maintain outside business, then the supporting business is little more than a passive operation, drawing off a steady stream of earnings, and this is similar to having an investment like a bond or royalty trust, which could be subsequently sold off. And so the distribution of such a corporation is comparable to a distribution of bonds or royalty trust. Next consideration factor suggesting a device would be a pro rata distribution. If the distribution is pro rata, this is some evidence of a device. The theory is that pro rata distributions tend to have the look and feel of a normal distribution. Turning to factors suggesting a device does not exist. First, corporate business purpose is a factor suggesting a non-device. The stronger the business purpose, the stronger the evidence. Second, if the corporation is publicly traded and widely held, that is evidence of a non-device. Third, if the distribution would otherwise qualify for the dividend received deduction, in other words, some or all the shareholders or corporations, there is further evidence of non-device. And then finally, transactions not ordinarily considered a device. As previously indicated, even if the factors suggesting a device outweigh the factors suggesting non-device, there may be transactions that would not ordinarily be considered a device. First, transactions involving corporations that don't have E&P. Second, Section 303 transactions, in other words, a transaction that in the absence of Section 355 would be treated under 303A, related to redemptions of stock for purposes of paying estate taxes or administrative expenses. And third, Section 302A transactions. In other words, if the transaction would ordinarily qualify, hypothetically, as if Section 355 did not apply, if it would ordinarily qualify as a redemption, treated as a sale or exchange under Section 302A, then the transaction is ordinarily not a device. Question 4A, illustrated in the diagram on the slide before you. A, an individual owns 100% of T. T company's only assets are stock and two subsidiaries, S1 and S2. S1 has conducted the widget business for the last 12 years. S2 has conducted the cog business for the last 8 years. Both companies were formed by T. P company is interested in acquiring the cog business but not the widget business, and P wants a cash purchase. To effect this transaction, T distributes S1 to A. A then sells T to P for cash. What consequences from this transaction? Well, on its face, do the initial distributions qualify under Section 355? Yes. S1, the controlled corporation, has an active trader business. T has an active trader business through its ownership of S2. In other words, the separate affiliated group has an active trader business. And so Section 355B1A is satisfied. So then what is the problem? Well, the problem is Section 355A1B, the device clause. More particularly, Reg 1.355-2D2 would treat the sale of the distributing corporation as substantial evidence of a device to bail out earnings and profits if this sale was prearranged or pre-negotiated. For example, was the sale reasonably anticipated? Presumably yes. Therefore, Section 355 cannot apply to the distribution, and the distribution would be treated under Section 301. Question 4b. Suppose instead that T distributes S2 and A then sells S2 to P for cash. What results? Well, Reg 1.355-2D2 will find a device whether A sells stock of the distributing company or stock of the distributed company. So again, the transaction does not appear to qualify under Section 355. In question 4c, illustrated by the diagram on the slide, same as A except that A exchanges all of her stock in T solely for voting stock of P. Would this change your answer? Well, how would one characterize A's exchange with P? You'll recall that this is a B reorganization, a stock-for-stock reorganization. A controlling stock interest in T is exchanged for P voting stock. That transaction might be an exchange, but it is not a taxable exchange. Therefore, the distribution of S1 is not considered a device, and so Section 355 should apply.